Let's say you have $50,000 to invest. Which would be the better option? Dollar cost averaging in or lump sum investing? Dollar cost averaging is where you break the investment into little pieces and you invest a little bit at a time. Now this could be every week or every month. Lump sum investing is where you invest everything in one go. Now, I too had been wanting to know the answer to this question for quite some time, so I decided to dig into the research and find out which one would be the better option once and for all. So in this video, we'll be looking at Charles Schwab is one of the biggest brokers in the world, so we'll take a look at the study that they did. Vanguard is also one of the biggest investment companies in the world, and we'll take a look at the study that they did, and then we'll bring it all together and summarize everything to take the key lessons. Now, these tests were both done on the stock market, but there's no reason why the same principles couldn't be used in other markets. As always, if you do find anything useful in the video, drop a like. Always very much appreciated. Okay, so dollar cost averaging or lump sum investing, which is best? Let's find out. So first up, we have the test that was done by Charles Schwab. So Charles Schwab decided to look at 20-year periods, and they actually looked at 68 different 20-year periods going all the way back from 1926 all the way up to 2012. And they also didn't just look at dollar cost averaging and lump sum investing. In total, they looked at 5 different investing strategies. So let's take a look. The first cohort was this guy, and this guy managed to time the market perfectly. So he was given $2,000 every single year, and this was for 20 years. It was invested in the S&P 500, but this was something that is pretty much impossible to do. They just wanted data on what you would earn if you managed to time the market absolutely perfectly every single year. Next cohort was this guy, and here is our lump sum investor. So again, given $2,000 every year for 20 years, invested in the S&P 500, and he invested a lump sum at the beginning of every year. Next cohort was this guy, our dollar cost average guy, given $2,000 a year for 20 years, invested in the S&P 500, and this time it was dollar cost averaged in at the first of every month throughout the year. Number 4, unfortunately, she had the very worst timing. So she was given $2,000 a year for 20 years into the S&P 500, but was just very, very unlucky. She invested at the worst time of the year, every single year for 20 years. And the final cohort was this guy, the procrastinator, given $2,000 a year for 20 years, but this time he just stayed in cash equivalents, in treasury bonds, and he was always looking to invest in stocks but never actually pulled the trigger. Okay, so what were the results? And this is what they found. So obviously the person with perfect timing was always going to do the best, but for this video we can see that lump sum investing was the next best, followed by dollar cost averaging, and then interestingly enough it was followed by the person who had really bad timing every year. They found that even if you invest at the worst time, you'll still beat someone who stays in cash or cash equivalents. And remember, they actually looked at 68 different 20-year periods, and in 58 of the 68 cases, these rankings were exactly the same. And this was the summary from Charles Schwab. Given the difficulty of timing the market, the most realistic strategy for the majority of investors would be to invest in the stocks immediately. Procrastination can be worse than bad timing. Long term, it's almost always better to invest in stocks, even at the worst time of each year, than not to invest at all. And dollar cost averaging is a good plan if you're prone to regret if an investment drops in the short term. So the research from Charles Schwab is that it's a win for lump sum investing. Okay, so on to Vanguard. Let's take a look. And now on to Vanguard. So Vanguard tested the amount of $1 million, and they actually did it in 3 different countries: America, UK, and Australia. And this time it was done in 10-year time periods. So the lump sum investing was obviously done straight away, but the dollar cost averaging was done at the beginning of every year, so done in 10 parts. And what were the results? Well, take a look. And these were the results. And interestingly enough, remember this was based on 10-year periods this time, but for the United States, United Kingdom, and Australia, the results were very similar. And again, it's a win for lump sum investing. They pretty much found that 2 out of 3 times you're going to be better off investing it all at once instead of dollar cost averaging. And they also ran these results not just in stocks, but they also did a split between equities and bonds, and also 100% bonds. So you just saw the results for stocks, but for the 60-40 split, the results were pretty similar in all 3 countries. And for 100% bonds, it did come down a little bit, but the results were pretty much the same. And it's a win for lump sum investing. And this was the summary given by Vanguard for their test. We believe lump sum investing immediately to gain exposure to the markets as soon as possible is the most prudent strategy. But if the investor is primarily concerned with minimizing downside risk and potential feelings of regret resulting from lump sum investing immediately before a market downturn, then DCA may be of use. So statistically, investing all at once as soon as possible, more often than not, will make you the most money. But it may not make you the most happy and content. Dollar cost averaging may not give you the maximum return, but it does give you additional psychological benefits. You will probably feel better doing dollar cost averaging. And this also reminds me of the research that was done by Dave Ramsey when it came to paying off debts. And if you had 5 credit cards, which one do you pay off first? The one with the highest interest rate or the one with the lowest amount owed? Mathematically, it makes sense to pay off the one with the highest interest rate, as this one is costing you the most money. But what Dave Ramsey found and what he teaches is that you pay off the one with the lowest amount owed first. And why would you do this? Because psychologically it gives the person a great boost, and they found that they then go on to want to pay off the next card. And the lesson is that we shouldn't underestimate the psychological benefits of investing. A lot of times it's not just about the numbers. So there you are, guys. Hope you found this useful. In fact, if you did, don't be shy, drop a like, and a big thank you to everyone who does. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.